Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, we need to talk about stock buybacks, also known as stock repurchase programs. Now, why are we talking about this today? There are two reasons. Number one of y'all asked me a question via DMs, and another person asked me in the comments on public and on Instagram. And I said, okay, look, y'all asked me 3 times. Sounds like I got a topic for our next video. So let's go ahead and talk about it. But the second reason also is Amazon announced they're going to do a $10 billion stock buyback, which begs the question, like, wait, what is this? Is it good? Is it bad? What does it mean for me as an investor? So I'll quickly run over the high level overviews, give you the pros and the cons that you should be aware of when it comes to a stock buyback. Stock buyback is really simple. What it is the company says, look, I'm going to go out there on the open market, I'm going to buy X amount of my own shares, or put in X amount of money, or commit X amount of capital. I got 10 billion in the case of Amazon. I'm going to go spend that on Amazon stock. That's basically what it is. A more tangible way is, let's say, for my book, which you should purchase from Burning Your Blueprint, that link is always in the description below. But let's say that I want to boost the value of my stock or my book, right? If I want to be a bestseller. And keyword here in this example, which is not true, but let's say that there are only but so many shares out there. If you go to Yahoo Finance right now for any company, it'll tell you the shares outstanding. There are no more shares after that, right? That's just it. And they can issue more, but if they do, that's going to hurt the stock price, right? It's going to affect the stock price. But let's just say there are only, I don't know, 1 million of my books out there, and I go out and I buy 500,000 of them, and they're all mine. That means the remaining books, the value of it is going to rise. That means that you have created a demand issue. And when you have that higher demand, you're going to command higher prices. And that is basically the mechanism here, that they are going to boost the value of their own stock by buying it and buying $10 billion of it. That's how, that's what Amazon is doing. Now, this is relatively common. The financial industry, JP Morgan, Bank of America, Morgan Stanley, they're most famous for this, but actually Apple is one of the biggest culprits, if you will, when it comes to stock buyback. So I'm going to read a very, very quick list of some of the biggest companies in the S&P 500 who do the most share buybacks. So I'm not going to read the whole list. I will put the list here. It might be a little small. It's small on my phone anyway. Top of the list, Apple, Alphabet, Meta, which is Facebook, Oracle, Microsoft, JP Morgan, Financial, Berkshire Hathaway, probably Financial, depending on who you ask, Bank of America, I'm skipping here, Lowe's, Home Depot, Procter & Gamble, Citigroup, another financial company, MasterCard, and Visa also on this list as well. That's just a few of them, okay? It happens all the time. And again, it's one way to boost shareholder value. Now, if you go and look into any economics textbook, maybe even a finance textbook, I was an econ major, so I read more of those textbooks than the finance textbooks, but conversation for another day. In either case, though, if you look up the definition of a company, the definition will be to boost shareholder value. That is what they are there for. And share buybacks are one way to boost shareholder value. Now, if you ask me, is the laziest way to do it, and it's probably not the best long-term thing as a company, like the quality of a company. The reason why is because on the downside, shareholder buybacks are not the most efficient way of using the money that you have. The $10 billion that Amazon is using to buy back its own shares could have been used to, I don't know, pay employees more. You could have used it to buy more electric trucks. Perhaps you could have just saved it in cash to offset the money you could be losing by not having your products in Russia, because they cut off Russia from all their services. Maybe you could have saved that and said, look, I don't need Russian money. I'm going to just save this myself since I had $10 billion to spend anyway. You could have donated the money. You could have done a lot of stuff with $10 billion, right? But they decided to say, I'm going to boost shareholder value. I'm going to make my own shares more expensive and grow my own wealth by just buying my own product, which in this case we're talking about the stock market. It is totally legal and within their right to do, and it does benefit retail investors like us. If you already own shares of Amazon or Apple or Meta or any of the stocks that were listed, you are going to benefit, and generally that is the case. Now, it's not guaranteed the minute that they do their share buyback the stock is going to shoot up. The reason why that's the case is because Never in my experience are they going to put the entire 10 billion on one single day. That would be wild. They usually split it up by quarter or however it is they want to do it. Perhaps they'll dollar cost average, right, and put it in on a regular basis. But in either case, this is a good way to boost the share price. If you look at some of the ones that are on the list, I'm sure Lowe's, definitely Apple, definitely Alphabet, probably Meta, maybe, they've all beaten the S&P 500 by a mile in most cases. One of those reasons was because of share buybacks, I'm sure. Now, the other thing, when it comes to shareholder value, dividends is one way to do it, right? Some companies just say, look, instead of doing a whole bunch of share buybacks, why don't I just give you the money? Which is what Amazon could have did. He said, look, I've got $10 billion and I'm going to give that money to you, the shareholders, in the form of a dividend. That would have also benefited shareholders, right? Would have been a reward for shareholders, and that might have attracted other investors to buy up shares too. There are a lot of people who only want to focus on dividend companies and don't want to invest in Amazon from a business case. Like Amazon got some issues. I'm not going to say a lot of you. Amazon got some issues, but there's some people who say, look, they don't pay a dividend, I'm not even going to look at them. That is a case, right? So they could have done that, which I think would have been a little bit better, or they could have used it to innovate, used it to create more products, which I think is the best case. The reason why I say that is because there are two primary issues. One, it is a poor and lazy use of capital. The money you got, you could have built more stuff, right? You could have been better with that. And we saw this in 2000, I want to say 2000, in 2020, it feels like 20 years ago, but in 2020 when the pandemic hit, airline companies said, look, this is really bad, we need help, we need government money to help support us, this is not good. Well, when we started to read the headlines and see where they spent their money, a lot of that money went to share buybacks, which means that you could have paid employees more, you could have kept that money in cash, you could have done a whole bunch of things with that money to protect yourself from a rainy day. Instead, you decided to go and buy up your own shares as opposed to investing that money in different ways to protect you from things like this. They didn't do that. So that's why we say it's an inefficient use of capital. The other thing that is a con, and where this comes into criticism, especially on Capitol Hill, is because a lot of CEOs and high-ranking members in a lot of these companies are compensated on how the stock performs. So if I'm a CEO, I need a bonus, I see inflation is high, and I need a higher paycheck, then I could just hit the lever, buy shares of my own company, shares go up, price goes up, I get paid my bonus. That actually happens, and that's not something that is the most prudent, right? Again, you could have did other things, right? You could have created a new product, launched something new that makes more buyers, then the value of the company goes up in a more natural and sustainable way, as opposed to just taking the money and just recycling it, buying your own shares, raising the stock price that way and getting paid that way. That's really a shortcut or a cheat code to raise the stock price and get paid more if you are a CEO of a company. So there are, again, pros and cons. Is every shareholder buyback, is every stock buyback a bad thing? Not necessarily. Some companies do it because they want to reduce volatility, right? If I'm one of the biggest buyers in the market, I don't want to see my shares immediately drop because people are overreacting. One way I can do that is by buying those shares and keeping my own market liquid and stable, and restore confidence in the stock that I have. That's totally fair. That is totally fair. Not every move is nefarious, but again, we got to talk about both sides of the coin. So when it comes to investing, is this the one thing that says they're doing shareholder buybacks, therefore I need to hop into the stock? Not necessarily, not at least for me. I'm not a one-issue investor. I like to look at the whole picture. I definitely like to look at context and say, you're doing a stock split, and you are doing a share buyback, and we're in the middle of a war, and we have the Federal Reserve making some announcements next week, and I know the tech companies are doing well so far in 2022. Weigh all of those factors and then decide whether or not it makes sense to buy an Amazon or any of these other companies. Apple was on this list. Walmart was on this list. Lowe's, Home Depot, they're on this list. All those are things that I would weigh and research to see what makes sense. Right now, the tough time to really pick stocks because outside of energy and maybe outside of defensive stocks, everything's kind of up in the air, and we don't know what's going to happen next week with the Federal Reserve, and we damn sure don't know what's going to happen next week with Russia's war in Ukraine. we don't know, right? So it does make it a little bit more difficult. However, it does build the contextual picture, which I think is one of the most important things when it comes to investing, especially if you are new. Because what I've seen happen is one good headline comes out and they say, oh, I'm going to invest in X company. So I've seen plenty of people, right? So while we did yesterday's video about whether or not you should buy based on a stock split. And I said, not the split. I want to look at everything and then decide whether or not I'm going to invest. And of those things, I think the buyback program is the most enticing thing. And that's what's going to make me feel better about it. When I talked about Tesla, when Tesla did stock split, go and check that video and late October maybe of 2020. I said, cool, they're gonna split. But then we found out they're gonna add it to S&P 500, and I said that was one of the reasons why I wanted to invest. So always weigh that stuff. For example, I had a conversation with someone earlier today online. It said they shut down all the stores, all the Starbucks stores in Russia. They've also done so with McDonald's. So, I think people are still going to buy coffee. I think this is a temporary dip. Now I'm going to hop in and buy Starbucks. I think this is a good move. I'm not here to say that it's not. It might be, right? But that one headline is not the reason I'm going to buy Starbucks. I want to know, how well Starbucks done in the last year? It's a question I don't know. How is inflation going to impact the cost of coffee, but also the stuff that they have to buy? Are they experiencing a work shortage, which every other restaurant is definitely having? I don't know that. With the rise in gas prices, are people going to go on their regular commutes, stop at Starbucks, pay more for coffee, and come right back home because people are still working from home? These are questions I don't have the answers to. But remember, like, I'm not solely seeing that one headline and deciding to invest. I'm taking all of these things and putting them together to give myself a better picture about whether or not Starbucks or Amazon or anything else is a good investment. So as an investor, weigh all the factors, weigh as many factors contextually. I think that's the most important word here, to see what makes a good move and what does not make a good move. All right, so now you know what a share buyback is. The last thing I'm gonna tell you. Y'all be talking a lot, which is a good thing. So I get a lot of comments and stuff say, hey, great channel, love the intro. I always learn, this video calms me down, all that stuff. I definitely appreciate that. That does keep me going, because doing videos Monday through Friday, something new, and I have to react to what's going on right now. I don't have the opportunity to pre-record a lot of times. Tell somebody, hit the share button, hit the like and subscribe button, and tell people about the channel. We hit 3,000 again. Goal by the end of the year, I'm trying to hit 7. Just trying to hit 7. So hitting the share button, telling people about the channel is one way to help us grow. Also, if you are inclined, you want to learn more about what I do and how I teach people my process for investing, make sure you go to the Investors Toolkit. The discount code is subscriber. That is also in the description below. It will help you become a better investor. You get monthly access to me, my stock list, and then my 7-step process as well. The discount is $300. You can use that until like next Thursday. So make sure you hop on it if you're willing and able. All right, that's it for me. Talk to you guys later.